Hello class, this is chapter 7 lecture on internal controls and cash. So the learning objectives describe the Sarbanes-Oxley Act and its impact on internal controls and financial reporting. Describe and illustrate the objectives and elements of internal controls. Describe and illustrate the application of internal controls to cash. Describe the nature of a bank account and its use in controlling cash. Describe and illustrate the use of a bank reconciliation in controlling cash. Describe the accounting for special purpose cash funds. Describe and illustrate the reporting of cash and cash equivalents in the financial statements. Describe and illustrate the use of days cash on hand to assess a company's ability to meet its cash commitments. So Sarbanes-Oxley Act, so what this often referred to simply as Sarbanes-Oxley, applies only to companies whose stock is traded on public exchanges referred to as publicly held companies. Its purpose is to maintain public confidence and trust in the financial reporting of companies. Sarbanes-Oxley highlighted the importance of assessing the financial controls and reporting of all companies. As a result, companies of this size or all sizes have been influenced by Sarbanes-Oxley. It emphasizes the importance of effective internal control. Internal control is defined as the procedures and processes used by a company to safeguard its assets, process information accurately, ensure compliance with laws and regulations. So Sarbanes-Oxley requires companies to maintain effective internal controls over the recording of transactions and the preparing of financial statements. So here's what it might look like graphically prior to the passage of Sarbanes-Oxley. Weak internal controls, fraud and theft, investors, stockholders, creditors are frustrated, enactment of the law. And then after passage of Sarbanes-Oxley, effective internal controls. Notice the little thing, the fraud and theft has decreased, as you can tell in the two images. So it went down. There's still theft and control and fraud, but there's more investor and stockholder and creditor confidence in the system and the process. So that's, notice he's nice and happy. She's over here frantic. So that's kind of what it would look like if you look at it graphically with a picture. Sarbanes-Oxley also requires companies and their independent accountants to report on the effectiveness of the company's internal controls. These reports are required to be filed with the company's annual 10-K report with the Securities and Exchange Commission, SEC. So management annual report on internal control over financial reporting. So this is an example. Our management is responsible for establishing and maintaining adequate internal controls. I won't go through and read that entire paragraph, but NAPI usually does fill out something like this just so that people, the stakeholders and equity partners know and have confidence in what goes on within the company. So this is usually put out. The objectives of internal controls are to provide reasonable assurance that assets are safeguarded and used for business purposes. Business information is accurate. Employees and managers comply with regulations. Let's see. Objectives of internal controls illustrated. So safeguard assets, accurate information, compliance with laws and regulations. And these are the objectives. Employee fraud is a serious concern of internal controls and is preventing employee fraud. So employee fraud is the intentional act of deceiving an employer for its gain. personal gain, that is. The 3 internal control objectives can be achieved by applying the 5 elements of internal control. These elements are as follows: control environment, risk assessment, control procedures, monitoring, and information and communication. Elements of internal controls illustrated. So here's the umbrella. It's preventing control environment. It controls the environment, provides a risk assessment, control procedures, and it monitors. So the information and communication is protected, management and the business is protected by this umbrella, overarching umbrella. The control environment is the overall attitude of management and employees about the performance or the importance of controls. 3 factors influencing a company's control environment include the following: management philosophy and operating style, the company's organizational structure, the company's personnel policies. Okay, so go ahead and take a look at those minor bullets. Control environment, organizational structure, that looks at the CEO and employees. The personnel policies looks at how the employees are guided by the personnel policies, which are the papers down here. These are the policies. Management philosophy and operating style. So this is kind of what happens here. So I'm on the board at NAPI, and that's one thing we look at is we look at the personnel policies. Not only that, but we look at the accounting policies and procedures and the internal control procedures, and we make sure the top management is abiding by and is leading the company based on the plan of operation as well, but these procedures. Then the CEO is responsible for the employees. I think about 3 years ago, we reorganized the NAPI so that there are proper internal controls, so that one arm of NAPI does not handle money. So it's very, very important to take those things into account. If not, whenever you have a yearly audit, they'll definitely flag you there and tell you to get your business structure and organizational structure into order. Risk assessment. All businesses face risks such as changes in customer requirements, competitive threats, regulatory changes, and changes in economic factors. Management should identify such risks, analyze their significance, assess their likelihood of occurring, and take any necessary actions to minimize them. Control procedures. Control procedures provide reasonable assurance that business goals will be achieved, including the prevention of fraud. Control procedures include the following: competent personnel, rotating duties, and mandatory vacations, separating responsibilities for related operations, separating operations, custody of assets, and accounting, proofs, and security measures. So a little bit more on control procedures, competent personnel, rotating duties, and mandatory vacations. Successful companies need competent employees. I'll let you go through this one because this is kind of a lot of text just to read, but it's very important that these are in place. These are procedures, and these help mitigate fraud from occurring, or theft and deceptive practices from occurring. Also, some of the responsibilities are divided. For example, if a physical check is written, sometimes companies will have 3 people sign off on the check, or 2 people, and they have to be management, so they're upper level management that will have to sign off on checks. Some others on Navajo Nation, there's an extra component of procedures, and they call it business regulatory, where they make sure that the Navajo enterprises, let's see, how would you say it, are giving preference to Navajo-owned businesses. So, for example, we did have a bid. We had a bid opening a couple months ago, and Navajo Regulatory was there to oversee that we provided every person or every company that submitted a bid the proper that we gave them, each company we provided equitable access to the bid, and I think it was like a $110,000 contract that we were awarding. But anyway, that's just an additional component of oversight that Navajo Enterprises have. Additionally, I won't read all of that as well, but for those reasons, the responsibilities for purchasing, receiving, and paying for supplies should be divided among 3 persons or departments. And this is very, very common. Now, if you have a small business, you're probably taking care of all 3 of those responsibilities, but it's your company. But the larger you get, you don't want the same person doing your purchasing, receiving, and paying for supplies, because there's cash there. They have access to the accounts, so just keep that in mind. But also keep in mind that if you have a small business, that you're going to be handling those duties. So it's not like you're going to be stealing money from yourself. But if you have an employee, man, you better make sure that you have these internal controls, because that money is important. Separating operations, the responsibility for operations, custody of assets, and accounting should be separated. I won't read all of these, but employees who handle cash receipts should not record cash receipts in the accounting records. To do so would allow employees to borrow or steal cash and hide the theft in the accounting records. So that's why you don't want the same person handling those. Proofs of security measures are used to safeguard assets and ensure reliable accounting data. Proofs involve procedures such as authorization, approval, and reconciliation. Documents for authorization approval should be pre-numbered, accounted for, and safeguarded. Pre-numbering of documents helps prevent transactions from being recorded more than once or not at all. Again, here's the internal control procedures illustration. There's all the threats, and there's management, and the business are protected. Don't forget, Sarbanes-Oxley prevents this. This umbrella applies to all companies, especially if they're publicly traded. But they also these same strict procedures are also they've been, I guess they went down to smaller companies as well, and enterprises. Monitoring the internal control system is used to locate weaknesses and improve controls. Monitoring often includes observing employee behavior in the accounting system for indicators of controlled problems. Warning signs of internal control problems. So these are a couple of signs. Abrupt change in lifestyle, close social relationship with suppliers, refusing to take a vacation, frequently borrowing from other employees. Now, this one is kind of important. The reason why they don't want to take vacation is because they have such strict, they have access to all this information, and if they're gone, they're going to be exposed. Frequent borrowing from other employees, excessive use of alcohol or drugs. So these are just signs. Warning signs from the accounting system: missing documents or gaps in transaction numbers, an unusual increase in customer refunds, difference between daily cash receipts and bank deposits, sudden increase in slow payments, backlog in recording transactions. So those are a couple. Information and communication, information about the control environment, risk assessment, control procedures, and monitoring is used by management for guiding operations and ensuring compliance with reporting legal and regulatory requirements. Management also uses external information to assess events and conditions that impact decision-making and external reporting. Okay, so this is just a checkup corner, so I'll go ahead and let you read that. Okay, this is some more information. Solution. So these are also in your textbook, so I won't go into too much depth into this information. Okay, these are what you would do. Limitation of internal control. Systems can provide only reasonable assurance for safeguarding assets, processing accurate information, and compliance with laws and regulations. And In other words, internal controls are not a guarantee. This is due to the following factors: human element of control and cost-benefit considerations. So in chapter 1, we talked about the fraud triangle. So there's a cost-benefit whenever people commit fraud or take money, basically. Cash includes coins, currency, checks, and money orders. Money on deposit with a bank or other financial institution is available for withdrawal is also considered cash. Cash is the asset most likely to be stolen or used improperly in a business. So a lot of times that's why you have a small amount of petty cash on hand, and you don't want a lot. You don't want stacks of money just hanging around. The temptation is too high to take it. To protect cash from theft and misuse, a business must control cash from the time it is received until it is deposited in a bank. Businesses normally receive cash from two main sources: customer purchasing products or services, or customers making payments on an account. An important control is to protect cash received in over-the-counter sales is a cash register. So here's an example: customer, cash, merchandise receipts. So the cash is sent to the cashier's department and the cash is deposited. Now notice these are all different sources. The cash register receipt goes to the accounting department, then the bank deposit ticket goes to the accounting department, and then it's journalized. These are all examples of that. They are separated. These duties are separated, and that's the importance of the internal controls over cash. Salespersons may make error in making a change for customers or in ringing up cash sales. As a result, the amount of cash on hand may differ from the amount of cash sales. Such differences are recorded in a cash short and over account. So here's the example of the cash over or short. Okay, so that's how you would take into account of it. Okay. If there is a cash shortage, the cash short and over account is debited for the shortage. If there is a cash overage, the cash short over account is credited for the overage. At the end of the accounting period, a debit balance in cash short and over is included in miscellaneous expenses and on the income statement. Alternatively, a credit balance is included in the other income section of the income statement. Cash is received in the mail. When customers pay their bills, the cash is usually in the form of checks and money orders. Most companies design their invoices so that customers return a portion of the invoice called a remittance advice with their payment. The document helps to control cash received in the mail. Cash may also be received from customers through EFTs, electronic funds transfers. For example, customers may authorize automatic electronic transfers from their checking accounts to pay monthly bills for such items as cell phone, internet, and electric services. In such cases, the company sends the customer's bank a signed form from the customer authorizing the monthly electronic transfer. Each month, the company notifies the customer's bank of the amount of the transfer and the date the transfer should take place. On the due date, the company records the electronic transfer as a receipt of cash to its bank account and posts the amount to the customer's account. Companies encourage customers to use EFT for the following reasons: cost less versus cash payments through the mail, enhances internal controls over cash since the cash is received. Don't forget, if it's done electronically, the money just exchanges into accounts electronically. That's why it helps it. It reduces late payments. The control of cash payments should provide reasonable assurance that payments are made for only authorized transaction. Cash is used effectively and efficiently. For example, controls should ensure that all available purchase discounts are taken. A voucher system is a set of procedures for authorizing and recording liabilities and cash payments. It may be either manual or computerized. A voucher is any document that serves as proof of authority to pay cash or issue an electronic funds transfer. In a manual system, a voucher is normally prepared after all necessary supporting documents have been received. For the purchase of goods, a voucher is supported by the supplier's invoice, a purchase order, and receiving report. After a voucher is prepared, it is submitted for approval. Once approved, the voucher is recorded in the accounts and filed by the due date. Upon payment, the voucher is recorded in the same manner as the payment of an account payable. So let me stop right there. I think this video is going to probably be about 40 minutes. I'll finish this up on video number 2.